Go ahead and get started today. So first, if we're paying attention to the markets are down today, mainly because of probably some anxiety of what's going on in Saudi Arabia, the Middle East, and just with oil prices in general, which I think is a perfect segue into homework 3, which is the EIC assignment that you worked on for this week. So we're going to spend a good chunk of the class going through homework 3 and then setting you up for what we're going to do Wednesday and leading into homework 4. Right? But before we do, I do want to talk briefly about the Bloomberg trading simulation and verify everybody's in a group. Everybody not in a group? Okay, just making sure. And hopefully you finish your certification by Friday. If we actually go to the Bloomberg trading competition, either idea or team message, then whoever is your team leader, this is section 201, 301. I'm going to say 201. Choose your section. Now, for you, I've changed the rights. So you won't be able to see the other teams. You'll see a bunch of X's. Right? You can't actually see what other people have bought or sold. I don't think that's actually going to be fair. But as the administrator, I can kind of see all. So if you go here and you click on the overall portfolio value from highest to lowest, this is how we're going to score. So for this section, L. Glazer, who's the L. Glazer team? Congratulations. You guys are in first place as of today. You have basically you made $4,000, $4,081, bouncing around a little bit. So if the competition were to end today, which it's not, you'd get 5 points. I'm in second place. I don't count right now, so don't mind me. Third place would be Armal. Okay, again, not far behind. You're at $3,080. If the competition were to end today, you get 4 points. And then C. Zhang, even though you lost money, you're in third place. You get 4 points as well because it gets relative performance, etc. So very important. Today is also the deadline to make sure that you have 70% of your portfolio in cash. So everybody has met that criteria, which is good, which is make sure you stay in cash throughout the semester. For the first half of the semester, I said you must have at least 10 longs, and we can see that all but one team has already met that criteria. Okay, so you had to have 10 longs by October 14th or 16th, whenever the first half ends, and most people have done more than 10 longs in the first week. Okay, so again, you'll do at least 10 in each half of the semester, but nonetheless, that's kind of where we are today. Any questions about the trading competition? All right, so let's talk about homework 3. That's the EIC assignment. So back to EIC. It was on United Airlines. And there were 2 parts to the EIC, or the 2 screenshots you had to submit. The first one was on the economy and the economic sensitivity of the airlines at United. So let's go here to Bloomberg. And if we had done UAL, U.S. equity, we would have then gone to RV. Now, just so we're all looking at the same peer group, as I had mentioned the assignment, I wanted you to use the analyst curated, and I wanted you to use the North American Airlines valuation peers. Because if you use the full service one, it takes out discount carriers like Southwest, JetBlue. So if you use this peer group, we should have all been looking at 15 peers, or 15 total companies. Market cap weighted average across the top. Click on markets. Click on beta. And that would have been essentially the screenshot that you would have submitted. And we have started answering the E question, addressing, is this industry sensitive to the economy? Yes or no? What number on here would we be answering that question based upon? Yes, sir. which is?
The industry's reaction to.
No, I'm saying, what's the actual raw beta?
Oh, for the market or United?
Start out with the market.
1.03.
Okay, so we're going to start out by answering the E question to say, does this industry have sensitivity to the economic part? What's the answer to that?
It follows the market.
Yeah, 1.03 is following the market up and down. So what about United? What's its raw beta?
1.3.
Okay, does economy matter to United?
Yes.
Just,
Slightly less.
there you go. That's part of what I needed you to basically understand. But nonetheless, whether it's United or the airlines, this is economically sensitive. So again, talking about the headlines today, there was an oil attack on the attack on the Saudi refineries, all right, over the weekend, and you can see on Bloomberg. I remember you could do your own Google searches. So if you type in oil prices, and for example, if we wanted to look at West Texas crude, oil prices today were up $7.68 to $62.53 a barrel here in the U.S. So basically, that's what, 12, 14%? Okay. So basically, this was the oil shock that you've been reading in the paper, but oil prices have spiked. Now, does that matter to the airline industry?
Yes.
Yes. Matter of fact, I had already told you when we started the class what's going on with the markets in the U.S. They're all down. So what do you think is going to happen to the major airline stocks? They're also going to go down. One, because their beta is 1.03, but more importantly, they're going to be sensitive to economic changes and oil. Why does oil matter to the airline industry? I'm sorry? But jet fuel, why does it matter? Yeah, it's one of the biggest expenses. About 20% or so of their cost is fuel. And so if fuel prices go up, it's going to hurt the entire industry. So the two parts that we know about the E part of the EIC is when there are economic things that are going on, this is an industry that's going to be impacted by this. So whether we're doing United or anybody else in this industry, we got to pay attention to what's happening in the economy. Okay? And that's really what part of the E part of this assignment is about. In fact, let's go back and talk about oil prices. GP, will graph the price, and this is 1 year worth of oil prices. But if I go to 5 years worth of oil prices, actually I'll go to a custom, and I'll go to 2012. So let me give a graph of 7 years worth of oil prices. Okay, so that's 7 years of oil prices through today, right? And one of the things that you'll see is that oil used to be around $100 a barrel, fell, bottomed out around 26, hanging out in the 40s to 50s, and then recently spiked up to the low 60s with what's happened this weekend, but nonetheless still lower than where it's been historically. So you guys all know this from your certification, but one of the other things I'm going to do is I'm going to hit compare, and I'm going to add in, compare it to UAL, and I'm going to normalize this to 100. So this is oil prices going down. This is United stock price going up. By the way, if I clicked over here and I looked at chart content, I'm going to put in Southwest, LUV, and I'm going to put in Delta. And what you're going to see is pretty much these industries are inversely correlated. That is, oil prices have been going down, share prices have been going up. Matter of fact, even today, as oil prices, and I'll go to 1 month, and you can see today, as oil prices spiked, all airlines down. All right. So again, this is kind of the economic sensitivity that we're talking about. So if I am valuing an airline, if I'm trying to understand an individual or the industry, I need to pay attention to what's happening to this economic data, and oil prices are going to affect it as well. The other reason I need to do this, just think about airlines themselves, is airlines are a giant fixed cost. whether or not anybody gets on that plane, the cost of that flight is pretty much the same. So they're going to be very sensitive to changes in demand. So if in the economy people fly less, well, lower yields on those planes is going to make it much less profitable for those airlines than higher yields on the planes. So whether or not those flights are full, it's going to have a big impact on this industry. So again, in bad economic times, you're going to see less leisure and less business travelers. In good economic times, you're going to see more leisure and more business travelers. That will help or hurt the airline industry. So one, we wanted to understand just conceptually, okay, economically sensitive, beta 1.03 for the industry, 90 something for United. But at the same time, we also have to understand some of the economic factors that are affecting that. And that's something we don't want to forget as we're paying attention to what's going on with the airline industry. Questions about any of that? That's your E. All right, so let's go back to this graph for a second. Why, and I'm going to take off just looking at crude oil prices, and again, I'm going to go back to 7 years. Here's 5 years, and I'll change this to 2012. So this is 7 years worth of data. Why did oil prices go from 100 to 26? Does anybody remember what caused that? What was behind that? Yeah.
U.S. oil production?
Some years U.S. oil production, but it was more Saudi. So who is the swing producer today? What nation's the swing producer that probably has the biggest impact on oil prices today? Who would you say? What country? What country do you think has the biggest impact on oil prices today as a swing producer? Adding or subtracting production? Who? Nope. It's not Kuwait. It's not Saudi Arabia. It's not Iran. It's not Russia. You're in the wrong part of the world. It's the U.S. Okay? So a little history here. So about 7-8 years ago, OPEC, which tries to control prices, and again, biggest OPEC producer is Saudi, basically saw the rise of U.S. production through shale, right? Fracking. Permian Basin, Texas, and North Dakota, South Dakota. So the U.S. went to become one of the largest producers of oil in the world and started adding capacity relatively cost effectively with fracking. Okay? And what Saudi Arabia was doing is to keep prices high, they would cut back on production to manage supply on the behalf of OPEC. But they were getting pissed off because the rest of the OPEC members weren't really cutting back on their production, and it was really Saudi taking the hit to benefit all of OPEC. So they were the ones that were losing the most market share as the U.S. was gaining market share, and they lost market share intentionally to allow oil prices to be as high as possible so they get the high price. But high price times less volume wasn't helping them, and the real beneficiaries were the rest of the OPEC members. So Saudi Arabia finally said, all right, enough of this. What we're going to do is we need to take back control, and we're going to drive the price of oil down. At the same time, wipe out the Americans. We need to put this to bed before they get too powerful. We're going to destroy that industry. So they went onto a baby pump strategy, and they just opened up the spigots and started pushing as much supply onto the oil market as they could. And they put the world awash in oil, and it drove the price down to $26 a barrel. And as they thought, started really hurting the American suppliers, and a lot of the frackers went into a bust cycle. They started laying off people, they shut down their facilities, they cut back on their expansion plans. Really hurt the industry. And then, once they were sure that they'd wiped out the Americans, they started cutting back on their own capacity, letting prices to rise, getting back to the orderly market that they were in. But then, something happened that was a flaw in their assumptions. What was the flaw? Why didn't prices go back up to 100 when they cut back on capacity? Yeah.
It's because the U.S. companies still frack.
Because the U.S. frackers added back the capacity that they had shut down. And what in my opinion, the assumption that they missed was that fracking is actually much lower cost and particularly much lower fixed cost than traditional oil extraction refining. And so they underestimated the low cost of the frackers, and that frackers could actually make money high 30s, around 40. So when oil went above $40 a barrel, frackers could actually put the capacity back in relatively quickly, and that essentially put a cap on oil prices. And that's the world we've lived in for the last 6 years. So basically, you can thank the U.S. for lower oil prices because we have been the swing supplier. And as the world needed more demand, the U.S. was basically cranking up the supply, and that kept prices in this commodity market relatively stable. Okay? But here's the deal. So now going forward, we have to decide what's going to happen, right? Number one is the shock in the Middle East temporary or longer term? Because if Saudi Arabia and Iran start going to war, start blowing the hell out of each other, well, guess what? That could drive oil prices up. That could completely change the dynamics here. And back to our original question, that could really affect the airline industry. Because if oil prices are at 60 versus 80 or 100, that's going to really change their profitability because it will definitely affect the industry. The other macro trend that we have to worry about is the economies in general. Is that the other benefit to oil prices is that global economies have been cooling. And with less demand from the global economies, less oil was being consumed, and that also put a cap on supply. So that has worked to the benefit of the industry. So again, I don't know the answer to this question, but this is actually one of the questions. So what's going to happen to the price of oil medium to long term? Is it going to stay 40 to 50? Is it going to go 80 to 100? What is it going to be? Because that is going to be an important decision if you think about whether or not you want to own airline stocks. Does anybody have a thought? And by the way, there is no right answer to this because we're dealing with the future. What's important is not only your opinion, but the assumptions behind it. Because that's how you're going to get graded in this class. Does anybody have an opinion on oil prices going forward? 3 years out, 5 years out? Yep.
I mean, I think 5 years out still is, I don't think your oil prices should change that much, especially since right now the oil prices haven't been previously so cheap. Likely airlines have hedged against that already for probably the next 10 years or so. So I think airline stocks will probably still be okay, at least the next 5 years. But
Okay.
after that, I think as other technologies come in, sustainable technologies, as the demand on oil actually is likely to eventually decrease. I would say. I'm not sure if it's within the next 100 years or so.
Well, if there's more sustainable technology, that should actually put even more pressure on oil prices. And that could be a benefit to the airlines themselves.
So I was saying, I don't think the market, there might be a high volatility, but I don't think that the market itself within the next 5 years is
Right. And so what's important is, I don't know whether he's right or wrong. And I can't tell you today whether he's right or wrong. But what I do appreciate, and this is what we all have to get better at practice, is articulate your assumptions. Because he gave not only a forecast, but he gave a rationale for that forecast. That is so much more useful than just saying, yeah, I think oil prices will stay relatively low long term. Okay, why? You just kind of left me hanging there. So again, that's what we have to practice. That's how you're going to be graded. So again, you got to be graded. Right, and this isn't like Looney Tunes crazy assumptions. Like this is realistic assumptions of the world. But he gave a very reasoned assessment. Now somebody else could have a different assessment, and it doesn't mean that somebody couldn't say oil prices could go higher. And here's my reasons for doing that. And that's the point. Then as an investor, I have to evaluate which one I think it's going to be. All right, questions about the E and what we needed to do for the assignment. All right, let's talk about the I, because I think these are very much a spillover. So for the I, again, second chart we would have looked at is we would have gone to United, we would have gone to RV, we would have gone to custom, we've gone to the spread, and let me delete this because you don't need that. So you'd have had basically this for your RV screen. And the first question under the I for the industry is this an attractive industry? And what numbers would you have said that you looked at to tell you it's an attractive industry? Yes, sir.
We took the spread, so now our ROIC minus the math.
Which is what? Just practicing using numbers.
12.29 minus 6.5.
Yep. Okay, so that's approximately 600 basis points, but given those numbers, an attractive spread. Okay? By the way, the reason why this is important, in the last class, somebody had actually said, oh, I didn't realize we were looking at spread. I just did my answer purely on ROIC. Okay, so on an ROIC, yes, it's an attractive industry, but they got there by looking at the wrong numbers. So that's why it's always important to give me your numbers to make sure I actually understand that it's about spread. It's not just about pure ROIC, because in that case, they were ignoring risk. They were only looking at return, and we're looking at the balance between risk and return when we make this assessment. Okay? Now, just in terms of the I don't want to talk about competitive advantage because the whole point is industry. 5 forces. What explains this industry spread? Why is this industry attractive? And this is the other comment I made last week, which is got to be careful about your biases. Because whatever you think about the airline industry, this is a very attractive industry right now. Okay, you're basically getting double your expected return on your investment relative to a cost of capital in this industry. And so that's pretty darn attractive. So why? Why is this industry in the context of the 5 forces doing well? Yes.
Well, we talked about oil prices going down, so that fuels like.
So which of those forces would you call that?
Like more supply.
So they're suppliers. So oil prices relative to supplier power, to some degree outside of the industry control, because oil prices are 20 to 25%, depending on the carrier, of an industry's cost in oil. But one of their biggest costs is favorable to the industry right now, and that is tending to help the industry. Okay? Now, while we're on supplier power, is all supplier power favorable to the industry? What part of the supplier power might be hurting the industry? Yeah.
Airplane manufacturers,
Yeah, because basically that's who?
Boeing and Airbus.
Primarily, you got a duopoly. And who has the power in that relationship? Boeing and Airbus. So to some degree, I mean, they'll compete, but they're not really competing on price. You're going to pay pretty close to full price for most of these jets. So essentially, you have the supplier power, the oil's helping them, the Boeing and Airbus can be hurting them, but it's not driving the spread negative. What it's probably doing is allowing the spread to be not as high as it otherwise could be. Okay? So why is this industry having such an attractive spread? What about those other 4 forces matters? Yeah.
So keeping other, no one's really entering the industry. Like there's not a lot of people entering the industry. It's got a lot of high barriers to entry. Cost infrastructure is very expensive between jets and maintaining airports. Also, their employees are relatively expensive as an industry, pilots, and also keeping security officials in place and up-to-date trainings.
All right, so let's start out with the barriers. Just start there. The barriers to entry are very high. How does that help the industry?
They have less their competition is only the companies currently in the industry. They don't have to worry about companies entering the industry.
So spills over to rivalry. So basically, the barriers to entry are also reducing the rivalry in the industry. As a matter of fact, many of you talked about in your papers the Big Four. All right, what's the market share of the Big Four? And Big Four, we're talking about American, United, Delta, Southwest. How much market share do they have? Yeah.
Combined, just about 80%.
A little under 80%. That's about as oligopoly as you get. So back to her point, the oligopoly, which is mitigated competition, which has reduced the rivalry in the industry, is because there's a lot of barriers to entry. It's hard to become a new airline. And that is a big barrier to entry for regulatory and safety and other reasons. So you're just not seeing a lot of airline startups. But there's another part of the barriers to entry that also matters. Okay? So I was telling the last class. So this weekend, I was in Cartersville, Georgia, which is not known for too much. It's known for the quarterback for the Clemson Tigers went to Cartersville High School. All right? And that's where they filmed the Avengers. But other than that, there's nothing to do in Cartersville. But my sister likes it. And it's about 35 miles northwest of Atlanta, Georgia. So the relevant part of the story is I had to fly from Atlanta back to Maryland yesterday. Can you guess what airline I probably flew direct? Okay, Southwest or Delta. All right, I flew Delta. All right. Why did you only pick those two? Yes?
Airports or airlines use hubs, so that economies of scale, I guess, is what you could
It's not just economy scale.
or use hubs.
Back to barriers to entry. Fortress hubs.
Reagan is owned.
Try flying out of Atlanta, not on Delta, direct anywhere. They control 90% of that hub. Who controls BWI? Who controls Philadelphia? American. Who controls Newark?
That's United.
That's United. Who controls Houston? United. Who controls Dallas? American. A little bit of Delta. Who controls Chicago? Chopped in half between American and United. Who controls San Francisco? United. So I'm saying this because the other thing, who controls Miami? Fly to Miami. Who are you flying on?
Lauderdale, Southwest.
Not Lauderdale. I'm talking about MIA. Miami. It's American. It's relative to the oligopoly. Is what they've done is they've chopped up the country. And they basically said, all right, American, you can have Miami. We're taking Atlanta. All right, United, you can have Newark, but we're taking Dallas. So they retreated to the fortress hubs. So what's happening a decade ago is the competition level was much higher. There were many more airlines, and they were flying to each other's cities direct. Now they've limited the amount of flights to each other's hubs. They all have these fortress hubs. And so for non-stops, it's actually much more profitable because they've eliminated your choice, which spills over to buyer power. You actually don't have as much buyer power as you think you do. Somebody was like, in the last class, like, think about all the sites. There's Kayak, there's Priceline, there's whatever even all the sites you can go on. Expedia, pick all the sites. By the way, when you go to Expedia, Cheap Tickets, whatever, it's actually the same company. Expedia owns like 18 different brands that are the same database, just remarketed to you. LastMinuteTicket.com, CheapTickets.com, it's all Expedia. Same database, just different interface. But the point of the story is, I challenge you to go to a major city to major city, try and fly there direct. You're going to get one or two choices, usually one choice for the primary airline, and the prices aren't going to be cheap. Especially if you go in like less than 7 days or you don't have certain restrictions. Because what we've done is they've taken the buyer power away from us. We don't have as much power because there's just as much choice. And that was intentional by the airlines. Here's the other thing they have done. Go here to comp sheets, op stats. These are statistics specific to the airline industry. Look at load factor. Does everybody know what load factor means? Yeah, it's how full the planes are. Average plane is 86.44% full right now. So here's the deal. What used to happen is when the planes got full, they'd add more planes. And they'd compete with each other at a lower price. Now what the airlines do is when the planes get full, they raise the price. And if you don't like it, they drag you out of the plane. And they just bump you. They don't care. They're making money. And that's the point. They've controlled supply. And because they control supply, good luck trying to get gates. That's the next thing. You want to fly to BWI? There's no more gates at BWI for you to license because all the gates are actually locked in. So who's even going to get those gates in the startup airline? JetBlue's having trouble moving across the country. So I go back to, this was somewhat intentional, and the end result is higher prices. Higher prices, more margin, more attractive industry, taking away the power from us. Here's another way they've taken the power. You know what the most profitable thing for an airline is? Where do they make almost all their money? And I'll give you a hint. It's not flying you from A to B. It's not on the fare. It's the fees. Credit card fees, bag fees, seat fees, change fees, non-refundable fees. All those fees are more than half the profit of the airline industry. So that's the other thing. And by the way, think about what a non-refundable fee does. If you buy a non-refundable ticket, you got to pay $150 or $200 to change that ticket. So therefore, you can't really switch to the lower cost fee if somebody gives you a better fare because you're already locked into that airline and it's very difficult to change. So these are things that take away your power, take away your switching costs, and are things that are helping the industry spread. So buyer power, we don't have a lot. Barriers to entry, she pointed out, pretty high. Not just to get into the airline industry, but even to get to the different cities that they've already carved up the country on and created their fortress hubs. What about suppliers? Next. What about substitutes? Yeah.
There's like high-speed rail.
High-speed rail in the U.S. Is that a viable substitute? I mean, I was in China. I went from Shanghai to Beijing, which is 800 miles in 4 hours and 40 minutes. It was pretty freaking cool. Can't do that in the U.S. I didn't take Amtrak to Atlanta. That would take 20 hours. It would have been a miserable experience. Yeah.
For a convenience factor source of travel, there are no easy substitutes in the U.S.
Therefore, benefits the airline industry. Matter of fact, technology substitutes. What about WebEx, Zoom, Google Hangouts, all those GoToMeetings, all those online tools? Is that hurting the airline industry? Is that slowing down leisure travel? So do you just want to look at San Francisco over video, or do you want to go there on vacation? Yes.
I don't think it's slowing down leisure travel, but it could be slowing down business travel because a lot of people right now communicate with people in their company.
Okay. So that's what I'm saying. Does it appear to be dramatically hurting the airline industry today? Maybe on the margin, but it doesn't really be hurting the industry. So substitutes are really not hurting the industry. So when you actually look at the five forces, it's pretty darn favorable, which is why the industry is making money. So here's the real question. Is this going to change in the next 5 years? Are any of those forces going to fundamentally change? Because what we're trying to figure out is this spread going to be about 600 basis points in the next 5 years? Or is the spread going to be different? Is it going to be lower or higher? So what about those forces could potentially change, if any? What'd you say there? Yeah.
Could you potentially see more acquisitions of the airlines themselves
Well, do you think that's reasonable? Do you think that's going to happen?
for discount airlines that are really struggling, like JetBlue? You could possibly see someone buying them.
But here, so does that actually help us or hurt us?
There would be less players in the industry.
So that could actually help the spread in a way.
Yeah.
You can actually argue the spread gets even better because we keep eliminating the choices rather than making more choices. So that sounds to me like same or better spread if there is more consolidation. Yeah.
For power suppliers, they're saying that commodities are maybe a little bit more paid, so it seems like it's not going to hurt.
So there is a labor cost, and by the way, if you've seen this, this should scare the hell out of you. But the American stuff is really scary. I mean, you had the guy who tried to sabotage the plane because he was pissed off. Did anybody read about that a couple weeks ago? Like American is canceling hundreds of flights a day because the pilots are and the maintenance people are in a protracted work grievance against them. Now the judge told them they're not allowed to strike, so they're doing all this other crazy stuff. This guy probably went to the extreme. But the point of the story is that could become labor unrest. And by the way, we haven't had labor unrest in this country in a while. Matter of fact, what's going on at GM today? Does anyone know what's going on at GM today?
Strike.
The UAW just went on strike. So what I'm saying is, if there's like crippling strikes and labor costs high, that could matter. But here's the real question. How much is labor as a percentage of a total cost for an airline?
But I think the pilots are 25-30%.
So is it going to be substantially higher that it hurts the airline's profitability? That they're going to raise prices? Don't know. But those are the assumptions. So we can have assumption one, which is much higher labor costs, which could hurt the margins and therefore change the supplier power dynamic and hurt the airlines. Or we could say marginal increases, it doesn't really make a difference. And oh, by the way, those pass it along to us because what else are you going to do if you don't want to fly? What else could potentially change or not change? Yeah.
Substitutes like
All right, so let's just talk about high-speed rail. I want to say two things about your comment. I made the same comment to somebody in the last class. I don't disagree with your general comment that there could be more high-speed rail. My reinforcement is in the next 5 years. Let me just reflect that back to you. Do you think there's going to be a lot of high-speed rail built in the next 5 years that's going to really affect the airlines? Yeah. So I'm just saying, long term, I'm not saying it's probably a trend that would matter, but in the next 5 years, I mean, heck, we can't even complete the Silver Line that goes to Dulles Airport. It's a year late and hundreds of millions of dollars over budget. There's no real high-speed rail projects that go long ways in the country. They just shut down the one in California, right? The only other two I'm aware of there's one that goes from like Fort Lauderdale to Miami, but that's not an airline route that's being displaced. And they're talking about doing one in Texas between Houston and Dallas and San Antonio, but I don't think that's like nationwide that's going to affect the airlines. So if you look at the actual horizon, we're probably not in the next 5 years going to do it, but longer term, we might. And again, that one's also political. Who's in the next Oval Office? Because if it's the guy that's there now, I don't think you're going to see a lot of high-speed rail, right? But again, that would just be a comment. But back to the point. I'm not saying I'm right. I'm not saying she's wrong. But this is what I want you to also articulate your assumptions. Because it's easy to say, oh yeah, well yeah, we'll have more substitutes. We'll have more online video. We'll have more high-speed rail. But I want you to think it through and think what the impacts are really going to be. And maybe I'm wrong. I could absolutely be wrong. She could absolutely be right. I can't ding her for the comment. But those would be two different scenarios for the airlines in terms of what would happen. And then we'd show that to the investors. Investors would then decide which one do they think is more reasonable. Anything else? Did anybody say that the spreads are going to get better in your actual homework? Anybody say they're going to get worse? Anybody say the spreads are going to go down to zero or negative? So we said worse, just slightly worse than today, but still a good industry. Right. I think that's a consensus right now in airlines, including by a guy named Warren Buffett. I'll show you something interesting. If you go to HDS, Warren Buffett used to hate the airlines. Now, Warren Buffett, which is called Berkshire Hathaway, is United Airlines' second largest shareholder. And if you click on Matrix, it'll show you similar holdings. You guys know all this from your certification. It'll show you similar holdings across other airlines. Ignore our class here. But in terms of actual shareholders, Berkshire Hathaway is one of the largest shareholders in United, Delta, Southwest, and American. So here's what Warren Buffett said. So a few years ago when oil prices went down, he sold ExxonMobil. And what he said was, I used to be bullish on oil, now I'm bearish on oil. So I'm getting out of the oil industry because I think it's going to become a lousy industry going forward. And he thought airlines were going to do well after hating airlines for a number of years because they realized they got into a smoky room, they chopped up the country, they decided not to compete with each other, they decided to act like an oligopoly. Now again, I don't think they physically said this because that would have been illegal, but they started acting this way. And the end result was, with lower oil prices and the oligopolistic competition, this industry's gotten very favorable. And they've had discipline so that when basically capacity starts to run out, they've raised price, not added capacity. They've constrained capacity increases. So long story short, he said, I don't know who's going to win, so he just bought them all. So Warren Buffett is either the first, second, or third largest shareholder in all four of our major airlines. And that's his view. And it's no different than the reasons that we're talking about today. Final question, your EIC. Does United have competitive advantage? So going back to our chart, did United have competitive advantage? Yes.
I said they had a slight competitive advantage because their spread was slightly higher than the industry spread.
So with the spread, the 12.29 minus 6.58, the 11.5 minus 5.62 was like 30 basis points more or something like that. Okay. So, yes. So the short answer is the answer for purposes of the homework, yes, they demonstrate competitive advantage. Now, it is minuscule, but nonetheless, it's a little bit better. Yes, sir.
I thought the competitive advantage for ROIC had to be higher than the industry.
It's spread. Its spread is competitive advantage. So spread of the industry, spread of your company, how do the two compare? That's the standard we're using in this class. Because if we just did ROIC, we're ignoring the risk. So it's the risk reward that we're looking at, not just the reward. Okay? Because somebody could get a higher ROIC because they're taking on much more uncertainty. So therefore, we're using the spread. That's why we're doing these assignments up front. Because if you're going to make that mistake, I need you to make that mistake small at the beginning of the semester, not later when the projects get bigger. So don't feel bad. That's why I also want questions. Clarify now. If there's any uncertainty, please continue to ask. Okay. All right. So we had to say, why is United doing slightly better? So does anybody have an answer to that? Like, what's United doing that makes them a little bit better than everybody else?
Well, I think because they are one of the major airlines, they're obviously able to keep their cost of capital down, which
Okay.
kind of helps out towards their spread.
Yeah, so you could have said that they actually do have a lower cost of capital, which is benefiting them. What else? Yes, sir.
Another question on cost of capital. The cost of capital is due to low cost of equity and that's due to lower beta. So that beta curve has shifted. I would say argue that is sustainable.
Whether or not sustainable over time is a separate question, but right now we're trying to explain why they're doing slightly better. So what you just said helps explain it. So nothing wrong with articulating that, but I also like where you're going with this, because just as we talked about the 5 years for the industry, we need to think 5 years for the company. And if we think for 5 years for the company, they're no different than the other airlines. Eventually, to some degree, to his point, the cost of capital is normalized so that the ROICs are the differentiator. It's not good for United's long-term competitive advantage. So that's another way of representing what you guys have just said. Right? And again, it's not a question of right or wrong, it just is what it is. Now, one of the reasons why their cost of capital is a little lower is they actually do lease a lot. And so they actually are using more debt in their capital structures. And that is benefiting them. You could also make an argument on the predictability route that they do have one financial advantage in their route structure, which is a competitive advantage compared to the other 4 U.S. airlines. Like, where does United really make their money as a differentiator? Does anybody know? I'll give you a hint. It's not domestically. United doesn't make a lot of money domestically. It's internationally. So where is United strong internationally? Yeah.
It's their business in first class.
But to where? Yeah, it's Asia. Like their San Francisco hub, phenomenally profitable. So, and to some degree, LA, because they really are the number one carrier that goes to Asia/China. And so take out the kind of trade nonsense we're having now, long term that's benefited United. So they're equally strong in Europe, much stronger in Asia, and that's where the growth has been, and there's a lot of premium travelers there. Actually, ironically, in the US, Delta is probably one of the strongest in the US because United actually has less business class seats in the US. And Delta has more business class seats in the US. And what the airlines have started to do, back to the lack of power that you have, is you can't upgrade anymore because increasingly people are buying access to the first class seats because they've made the coach experience so miserable that the business travelers are like, I'll pay the extra $100 so that I don't get an aneurysm in my leg, right? So essentially, instead of frequent flyers going up front, you're getting more paid travelers up front. And Delta's taking advantage of that. So one of the things United is doing, there's an article about this last year, is Delta had like 26% of its domestic seats were first class. United was only 20%. So United was actually adding more business class seats. And do you know how they were putting more business class seats in the front? So they didn't reduce the amount of total seats on the plane. They were cutting the legroom in the back. So that's the point. I don't know if you've paid attention to this, but the seat pitch, which is how wide the planes are between the seats, is now gotten even smaller that you're almost standing up. And the other thing they're doing is they're reducing the seat width. So it used to be 18 inches. Now the average seat width is 17 inches. And one of the airlines is actually trying to push 16. There's no federal regulation on this, by the way, which is actually the scary part. So we got to wait for somebody to die before the Fed states. So like this is just unhealthy.
Well, the chairs are getting better too.
I'm sorry.
The shares are getting thinner too.
And the chairs are getting thinner, exactly. And by the way, they actually, it was funny, one of the, is it CNBC or CNN or somebody, they actually put the CEOs of the major airlines in their own coat seats, and they interviewed them, and they said, you know, do you find this uncomfortable? Aren't you going to do something about it? And it was funny. It was the CEO of American. He said, what we're going to do about it is get people to pay more to be up front. That was actually his answer. So anyways, for better or for worse. All right, questions about this assignment? Yes, sir.
When we consider like beta, is it like the beta of the American market or like the higher market as a whole?
Well, if you think about the way we've set this up, we're looking at just US. So when we think about beta, if I wanted to go global, I would have to change this list to be the global list. And then once I change my list to a global list, then I would redo my beta. And I would be comparing it against a global economy, which is still 1.1. It's actually higher than it is in the US at 1.03. Okay, good question. Yes, sir.
When you're talking about these data, like I noticed, like especially for the one issue R squared, so kind of low. Is that?
Well, and as I said, that's the beta is the starting point. That's why the assumptions are also key. And every now and then you're going to see some data that just doesn't make any sense to you, and that's okay. Just say the data doesn't make any sense, right? But regardless, I just want you to at least start to think about these correlation and causations, and recognize with statistics they can also be sometimes misleading. That's a good point. All right, other questions? All right, homework 4, which is coming up. So I just want to give you a heads up that the next few classes leading into the midterm are going to be the hardest classes for you this semester, right? I'm just reminding you the drop ad has ended, and I recognize the hatred for me will reach an all-time high over the next couple classes because you're going to get frustrated, and it's okay, right? Because I also recognize it will eventually mitigate and things will regress back to normal and you'll be happy again. But the stress level for you individually is probably going to go up because what you're going to do in the next few classes you haven't done before. And it's new material. And it's not common sense material in the way it's been taught to you. So you're going to struggle with this. So I'd strongly recommend reading the book before next class. And it's going to be on converting economic statements. All right? Because what we do here this semester is unique. It's McKinsey's approach. Nobody else teaches this approach. In fact, the only 2 places in the country that teach this approach are here in Wharton. Nobody else teaches this. So it's a unique way of looking and analyzing statements that I am teaching you. And so I'm not going to explain it today, but I'm going to explain as a heads up why we do this. Okay? So I'm going to give you sort of a true story. So a few years ago, I was invited to go speak to a company called Molson Coors. You guys familiar with who Molson Coors is? Beer company. Okay, they do like Coors beer, you know, Molson Golden, basically cheap beer. Okay. Now some of you may not be 21, so you may not know what it is. But in any event, it's cheap beer. So, ticker symbol's TAP, T-A-P. And if you go to RV, by default, there's the beverage industry. And if you go to our spread template, you'll get a sense about how the industry is doing and how the company is doing. So just very quickly, looking at this public data, is this an attractive industry? It hasn't changed that much the last few years. Data's the same. Is this an attractive industry?
Yes.
Yes, because,
The EIC of 17.5 is greater than the 6.2.
yeah, this is actually better than airlines. This is a pretty darn good industry. A lot of money in beverages. How is Molson Coors doing compared to their peers? Not only not so well, they're actually destroying value. Okay? So the reason I was brought in is because they were basically going to take a big hatchet, start whacking heads, and say, we got to improve our performance, because Wall Street was kind of breathing down their necks and say, hey guys, you're really underperforming in a really good industry. Your growth is very value destructive. You got to go fix this business and fix it fast. And they were feeling the pressure. Okay? So they had a senior leader meeting in Fort Lauderdale, their annual meeting. It was at the Westin on the beach during February, during spring break. And I got to go speak. And it was kind of cool because instead of talking to a bunch of drunk students like yourself, I got to go talk to a bunch of drunk 40 and 50-year-olds at their annual beer conference, which was a celebration. I mean, seriously, like out in the hallway, they had like these big buckets of beer. It's free, you can just drink, and music is playing. It's a big party because it's the beer industry in Florida. There was their annual meeting. And I got 20 minutes on stage that basically when they weren't on break to basically go up, show them this data, tell them that they sucked, and tell them that bad things were about to happen to you as the outsider, so that when the layoffs happened, it wouldn't come as a complete surprise to them. Okay, and then, oh, by the way, go have some beer, have fun on your break. Like, that was going to be my message. So, true story. So I'm standing on the stage. I got the senior leaders. They're in round tables sitting at the front with the Molson family, the Coors family, the board members, and all the leaders in the room. I got a chart similar to this. I'm using Bloomberg because they had Bloomberg. Everybody knew this. It wasn't like this is private data. Similar data. And this was my message. All right, guys, you're actually doing pretty well. You got to actually find a way to expand your growth of the beer business to create more value. So keep up the good work. Try and improve a little bit at your peers, but you're actually doing a relatively decent job. Now, the room in the West End was just as quiet as the room here today. And people were looking at me like, huh? And by the way, this is not a joke. I was actually being serious. And this is why we're about to do what we're about to do. Because the data is misleading. The data that is taught in business school, that is used on Wall Street, that is defaulted in Bloomberg, is misleading. And this is something you're going to start to understand, and this is going to separate you from just about every other student in the country, and to some degree from the firms that you'll actually work for themselves. Because the ROIC in Bloomberg, the return on the invested capital, is the return on all of the assets in the firm. Both the operating assets, which in Molson Coors' case is the stuff that they use to make beer, and the non-operating assets, which have nothing to do with making beer. So when the rest of the world does ROIC, what they do is they say, what's the return on all the money you were given to run your firm? And the return on all the money you were given to run your firm is 4%, and it is value destructing. That is a true statement. But if I'm actually talking to the people that make beer, it's a little misleading because in this number is stuff that has nothing to do with making beer. So here's what we're going to start doing on Wednesday. We're going to take the capital, the assets of the company, and we're going to put them into operating assets, the things that actually make your product or service. And we're going to have another bucket called non-operating assets, which are the things that have nothing to do with making your product or service. And then we're going to take your profit, and we're going to do the same thing. We're going to take the profit that actually you use to make your product or service, in this case make beer, and we're going to put it in one bucket. And the other bucket, we're going to take the profits that have nothing to do with making beer, and we're going to put them in the non-operating bucket. Return on operating assets, return on non-operating assets. Operating ROIC, non-operating ROIC. When you put the two together, you get 4%. That's the company. But when you break them up, this, add column, and this does not exist in your Bloomberg terminal, this will be a custom formula that, as a future assignment, you will put into your Bloomberg terminal after you learn how to reorganize the statements, called operating ROIC. This is the operating ROIC of the people that make beer. The operating profits for making beer divided by the operating investments in the actual facilities that make beer. Now, is this spread positive?
Yes.
Is it as positive as the rest of the industry? No. Should they improve? Yes. But should they kill the growth? There's the nuance. Because you had homework too. What happens when you have a positive spread and you slow the growth? That's what they were about to do. Because they were being misled by their own financial statements because the company had a negative spread. But the people that are actually making beer didn't have a negative spread because the operating and ROIC and the non-operating together gets you to the average, which is 4. So what's the real problem here? The non-operating, yet they were getting ready to cut a bunch of the operating people. And they weren't going to address the non-operating problem. So this is what I am going to teach you to have this insight over the next several weeks. Yes, sir.
What are some of the things that would have been considered non-operating for that company?
They had spent hundreds of millions of dollars putting money into a joint venture with a company called SAB Miller that was losing money. And so basically the people in the room that I was dealing with were being judged on the sins of a joint venture that they had no part of, that they didn't control or operate, that the company had put all the money in and was losing money in, had nothing to do with their making and selling beer. Yet they were the ones that were about to be penalized for this. So that's what I'm saying. This is common because the way the data is presented so easily and simplistically doesn't break out operating and non-operating ROIC. And it doesn't even call your attention that something else might be a problem. You just say, oh, business is a problem, operating is a problem. So let me just show you. If we go to the railroads, Union Pacific, one of our first assignments, look at the difference between the operating ROIC and the regular ROIC. ROIC LF is standard Bloomberg. Op ROIC will be the custom approach we take this semester based on the McKinsey format. Is there much of a difference? The answer is no. This is actually the point. Historically, there wasn't a lot of difference between the two, so nobody cared in the textbooks when they first wrote the textbooks because there weren't a lot of non-operating assets. And in some industries, there still are not a lot of non-operating assets, so this doesn't matter. But let me show you Google. Look at the tech companies. Is there a big difference? See, this is why it matters. So I'll use Google as an example. This is how we're going to handle our valuations. Now again, we're going to get here with what I'm about to tell you, we're going to get here over the next month. Okay, this is post-midterm stuff, but this is what I'm going to eventually get you to. But in order to get you to, we got to understand the building blocks. So I'm going to forecast Google. Okay, so I have to forecast how much cash Google's going to generate. So let's go back to KVD. ROIC for Google is what in Bloomberg? What's the number in Bloomberg? 14%, right? So what that means is for every dollar of investment, Google generates 14 cents of after-tax profit, and then they're going to grow it at some rate. That's a key value driver, and that's going to be their valuation. Okay? But here's the thing. In order to sell the next dollar of Google AdWords, Google's got almost $100 billion worth of cash. Does Google have to borrow another $100 billion worth of cash to sell the next Google AdWord? Well, that's what 14% assumes. Because the 14% says that to get the incremental dollar, what I have to do is take all of the investment and repeat itself. So I am going to undervalue Google because I'm going to assume that Google has to make all these investments to actually make their business. But if I actually look at what they've spent on Google AdWords, they're making 32%. So when they sell the next dollar of Google AdWords, they're actually going to make 32 cents of profit. They don't have to actually borrow a bunch of money that's sitting in Ireland they're waiting to pay out and distribute because they don't want to pay taxes on. So here's the point. That is going to dramatically change the value of Google. Right? And I will undervalue Google if I assume that their future ROIC is 14% because that assumes they're going to take all those non-operating assets and repeat themselves. But they won't. Same thing with Molson Coors. If I have a 4% ROIC and I sell beer at 14 or 12 and I have non-operating at negative or 2 or something low, if I stop my non-operating and I keep selling beer, my ROIC is eventually going to be at 12 or 14. So that's what people miss when they do their valuations. All right, I'll give you an example of Apple. So I am an iSheep. I bought an iPhone on Friday for delivery this coming Friday for over $1,000. Okay, I don't have a good explanation. I'm just a sheep. Right? So I'm going to trade in my iPhone, get the new one, spend a ton of money to do so. But here's the thing. You'll notice Apple's ROIC on this chart is what?
25%.
Their actual operating ROIC is over 200%. This is why Apple's a $1 trillion company and people don't really understand Apple. So I just want to ask you a very simple question. The iPhone that I purchased on Friday, right? Who made it? Foxconn in China. Okay? So how much are they paying Foxconn for my $1,000 iPhone? About $400. I'll round off. So they sold me an iPhone for $1,000 on my credit card. They're basically buying it from China at $400. Right now it's in Alaska somewhere, flying here. I was tracking it. Okay? It's going to be delivered on Friday. But the point of the story is you're making $600 on that iPhone. Huge profit margin. Okay? So how much net PP&E, property, plant, equipment, did Apple spend to manufacture that iPhone? How much physical plant to make the iPhone did Apple spend? Zero, because Foxconn did that. How much inventory did Apple build for that iPhone? None, because they don't actually buy the phone until they got it from me, from Foxconn. So they got no inventory in the US. All the inventory is being held by Foxconn in China. They have very little inventory, maybe a day or two in the US. That's it. How much receivables does Apple have? Accounts receivables. How long before they get paid? 2 days. It's credit cards. You don't get net 30 on an iPhone. So they got no receivables, they got no inventory, they got no PP&E. How long do you think it takes for them to pay Foxconn for these phones? 45 days. They're holding on the money for 45 days before they give the money to Foxconn. What's the invested capital? What invested capital is Apple actually putting into making this iPhone? Next to zero. Who is putting in all this money? Foxconn's got hundreds of thousands of people, tens of billions of dollars of facilities, tens of billions of dollars of inventory, and they're the one waiting on Apple to give them all the money, and they're doing it at a low price. See, that's the secret of what Tim Cook did with Apple. It was the supply chain. Is he got somebody else in contract manufacturing to take all of the financial risk. So the operating ROIC on the iPhone is astronomical because it's all profit and no investment. It's not 25%. Think of it this way. If they have $60 billion worth of profit at 20% tax rate, we'll call it simple, that's $50 billion worth of profit after tax. $50 billion you get to 25% means $200 billion of investment. They don't have $200 billion of property, plant, inventory, and receivables on their balance sheet. They just don't. You know what they have $200 billion in their balance sheet of? Cash. Non-operating asset. That's the 25% ROIC that you see. So when people forecast Apple, they just assume that 25% is going to repeat itself. But what you're basically saying is they're going to keep borrowing a couple $100 billion worth of cash to make these next iPhones. That doesn't make any common sense. Yet that's what the valuation models that are used at academic institutions are telling you to do when you use the ROIC latest fiscal year that's in Bloomberg by default. And this is what you're going to learn is a mistake that people make, which is why they have trouble valuing a company like Apple, trouble valuing a company like Google, because they're not separating out the operating and non-operating. They're putting them together, and they're just assuming that's incremental. And that's one of the things you will not do this semester, because what you're going to do is separate it out. You're going to value them separately, and in an MPV world, you're going to add them together. That's eventually what I'm going to teach you to do, and your models will be better for it. And by the way, that's why McKinsey wins versus Goldman Sachs and JP Morgan, because that's McKinsey's approach versus the traditional iBank's approach. And McKinsey gets easier explanations with their models than the banks do. Now, it's not for every company, because if you don't have a lot of non-operating assets, there's not much of a difference between the two. But when you do see a lot of non-operating assets, the McKinsey approach is better. And that's what I'm going to teach you how to do. Yes? What is what? The dash means that Bloomberg, given the custom field, is having trouble calculating it in real time. So, for whatever reason, but I'm telling you, if we were to go to the actual balance sheet, you're not going to see hardly any PP&E. You're not going to see any inventory. You're not going to see any receivables. And what you do has really nothing to do with their manufacturing. It's the giant spaceship campus and all their retail stores. That's where they are spending some money. That's why it's not infinite ROIC. It's about 200%, but it's 200%. It's not 25% because it's all the non-operating assets for Apple. So this is advanced. I don't expect you to understand everything I just said, but what I do expect you to understand is why you're going to hate me for the next couple weeks. Because the process of doing what I said is not easy if you've never done it before. And even when you do it before, it's not that easy because the accountants don't give us, here's non-operating assets, here's operating assets, here's non-operating liabilities, here's operating liabilities, and they don't do it consistently across companies. So that's going to be the fun part, and we're going to start this process on Wednesday. And your first homework assignment next Monday, just FYI, is pretty straightforward. Here's an income statement and balance sheet, convert it. By the way, midterm 1. Here's an income statement, balance sheet, convert it. I'll tell you today. Very straightforward. Okay? And to do homework 4, which will the conversion, one of two things will happen this weekend. It'll either take you an hour and make complete sense, or it'll take you 5 hours and you'll give up. So my goal in our next class is to make sure that it takes you an hour and makes complete sense. But nonetheless, reading the book probably is a good way to start. See everybody on Wednesday.
All right, Professor, take care.
Yep, you too.
I'm the same. Bye.
Oh, yeah.